Hello investors. This video is a guide to the human mind, the mistakes it makes and how you can avoid them as investors. To avoid a mistake, we first need to understand why we make it. Therefore, before we get to investing, let's go back into the past. Evolutionary pressures shaped our brain just like they shaped our bodies. In the past, our ancestors were rewarded for jumping to action without getting complete information. मान लीजिए आप 8000 साल पहले अपनी कैटल को घास खिला रहे हैं और आपको घास में एक सांप के चलने की आवाज आती है। हो सकता है ये आवाज बस हवा की हो, पर अगर आप फुल इंफॉर्मेशन के लिए वेट करते तो आपको जहरीला सांप काट सकता था। उस वक्त चतुराई बिना ज्यादा सोचे भागने में थी। Situations like these created heuristics. Heuristics are mental shortcuts which worked in the past but may not work today. Our brain has not evolved as quickly as our environment. आपका दिमाग अनअपडेटेड सॉफ्टवेयर जैसा है, इसलिए आप अपने हर इंट्यूशन और इंस्टिंक्ट पर पूरा भरोसा नहीं कर सकते. As an investor, you need to make rational decisions. Therefore, let's look at 5 cognitive biases that investors should avoid. Number 1, confirmation bias. Confirmation bias is the human tendency to selectively take in information that confirms what you already believe. मान लीजिए आपके आगे 5 फैक्ट्स रखे जाते हैं. You are more likely to pay attention to the facts that reinforce what you already believe. आप उस इंफॉर्मेशन को देखा अनदेखा कर देते हैं जो आपके existing beliefs या values के खिलाफ जाते हैं. Confirmation bias can make traders ignore important information that goes against what they believe. Therefore, traders should avoid it. Even if a piece of information is emotionally unsatisfying, traders should still take it seriously. That information might help them avoid a loss. Which brings us to our next cognitive bias. Number 2, loss aversion. Loss aversion is the human tendency to hate loss more than to value gains. If you have nothing and you win rupees 500 in a lottery, you will feel good. If you have rupees 5,000 and you lose rupees 2,500, you will feel horrible. Even though you objectively have 5 times more money than the first scenario. Happy with rupees 500, but dissatisfied with rupees 2,500. Such are the contradictions of the human mind. You can understand loss aversion through this graph. The pain of losing rupees 100 is greater than the pleasure of gaining rupees 100. Less aversion is problematic for investors as it can lead to risk aversion. Without calculated risks, it is difficult to get good returns in financial markets. Number 3, overconfidence bias. This is a very dangerous bias because it boosts the self-esteem of people who have it. People with overconfidence bias tend to think they are right more often than they actually are. Real results do not match their belief in their abilities. They have an illusion of control. They plan to achieve a lot of things in an unrealistic little amount of time. They think they are better than others when they are average or below average. An investor needs to know that even the smartest people make mistakes, and so it's best to stay humble. Be critical of ideas you are most proud of, and your investing game will improve. Number 4, familiarity bias. Exploring new options and thinking of fresh ideas is hard. Exploratory behavior takes up mental and physical resources. Therefore, people prefer to stick to what they know. This is called the familiarity bias. Joshua Cowell wrote in a 1999 paper that wealth managers tend to invest in companies that are geographically closer to their own workplaces. This is also an example of a familiarity bias. Familiarity bias hurts investors as there are always great opportunities outside of their comfort zones. People should not mistake familiarity bias with their circle of competence. The circle of competence is a set of topics you are knowledgeable about. Investors should attempt to stay inside this circle as much as possible, while also expanding the circle as much as they can. Markets are dynamic and reward dynamic individuals. Number 5, attention bias. Because of the attention bias, investors tend to buy stocks that their attention falls on. There are 3 problems with this approach. First, stocks can grab attention for the wrong reasons as well. When it comes to stocks, not all publicity is good publicity. Number 2, in his paper, All That Glitters, Brad Barber takes the example of a forgotten vacation island that is mentioned on the news. A vacationer goes to the island but is surprised to see a crowd. Just like him, hundreds of people saw the news and decided to come here. The island was no longer forgotten and the vacationer does not get the peace he was hoping for. Something similar happens when investors rush to buy stocks mentioned on the news. Everyone does the same thing, and no one gets the returns that they were hoping for. Number 3. Just because a stock is attention worthy does not mean it is investment worthy. Financial markets reward investors who spot opportunities before everyone else. To do this, you can't be looking where everyone else is looking. Don't get us wrong, following the market can be rewarding, but finding hidden gems is rewarding too. Learn to strike a balance. Here are all the cognitive biases discussed in this video with their definitions. Confirmation bias. Selectively take in information that confirms what you already believe. Loss aversion. Loss aversion is the human tendency to hate loss more than to value gains. Familiarity bias. The tendency to stick to what you know to reduce mental effort. Attention bias. Buying stocks that your attention falls on. Overconfidence bias. Believing you're right more often than you really are. Take a screenshot for future reference. And since you watched the full video, here's another bonus bias for you. This bias is called groupthink. इस bias को madness of crowds भी कहते हैं. Investors crowd को follow करते हैं, ये सोचे बिना कि वे जा कहाँ रहे हैं. Groupthink की वजह से past में tulip mania जैसे bubbles बने और burst हुए. चलिए दोस्तों, आज के वीडियो में बस इतना ही. Which bias have you noticed in yourself? Tell us in the comments below. Don't forget to share this video with your friends who may find it useful. Subscribe to not miss our upcoming content.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.